Well, U.S. natural gas futures are struggling to regain their balance after last week's aggressive liquidation, hovering just north of $4 on Monday after tagging a $3.99 intraday low. The bounce comes after a $1 washout that wiped out almost a month of upside, with January contracts now sitting right on the $4 support line. Weather still matters, but the real question is whether this move ends in capitulation. The fundamental backdrop remains heavy. U.S. dry gas output has surged to a record 109.7 billion cubic feet per day this December, with storage levels running 1.3% above the 5-year norm, set to briefly dip slightly below the 5-year average next week before rebounding again as the warmer second half of December kicks in. Demand is lackluster, and forecasts calling for one of the warmest late Decembers in decades add fuel to the bearish fire. Even with futures technically oversold, the market continues to bleed. Even with LNG exports running strong, they're failing to move the needle. Dutch TTF is parked at a 19-month low, while Asia's JKM is hovering near $11, hardly bullish reference points. That global price softness blunts the impact of U.S. export strength. Call it what it is, LNG strength sounds nice, but without global demand or supply discipline, it changes nothing. Meanwhile, cracks between U.S. gas hubs are also widening. Henry Hub is managing to hold close to futures pricing, but Texas Waha Hub has repeatedly slipped into negative territory as pipeline congestion backs up supply. That's more than a regional headache, it's a clear signal of deep, structural oversupply. Futures prices are now signaling even deeper losses than previously anticipated over the coming months, reflecting persistent oversupply and weak demand. At this point, the only scenario that could provide meaningful relief for bulls is a strong polar vortex sweeping down from Canada in January, injecting a burst of winter-driven demand. Without that, the market appears positioned for continued pressure, with little to arrest the downward momentum in the near term. Nevertheless, in a La Niña year, anything is possible, as weather patterns can swing unexpectedly and upend market expectations. Technically, Monday's modest rebound shows little conviction. Resistance looms at the 50-day moving average near $4.48, with even heavier pressure at the 200-day around $4.70. Bottom pickers are active, but this feels more like averaging down than a genuine shift in sentiment. The issue is clear: too much weak length remains in the market. Until that flushes out, rallies are likely just opportunities for sellers. Prices are trying to find a base near the $4 handle, but there's no meaningful bullish catalyst yet. Without a sharp cold snap or a drop in production, the path of least resistance is lower. True capitulation, not mere consolidation, may be needed to reset positions. Until that happens, any bounce is suspect. If you enjoyed the video, drop a comment, hit like and consider supporting the channel, it really helps keep things moving, and see you next time.